Welcome back, guys, to another episode of Off the Block. Today we have a little bit of a different episode talking about the hard asset renaissance, the modern gold rush, if you will. Gold recently hit an all-time high above 5.5K. Central banks are buying at a record pace, and Bitcoin, despite being down 40% from its cycle peak, is showing signs of maturation. In our view, the world is repricing what safety means, and these two assets sit at the center of that conversation. With us, I'm happy to say that we've got Charlie Morris, who has spent decades in asset management and created the Bold strategy, combining both Bitcoin and gold, who will unpack why both assets matter now more than ever and why combining them may be the most elegant trade in macro. Charlie, please introduce yourself.
Well, thanks, Max. A pleasure to be here. When you say decades and decades, not that many decades, but probably too many of experience. But it all helps, unfortunately. Unfortunately, in this business, you start to understand it when you get really old, and that's really annoying. It's true. So my background was I was at HSBC Asset Management for many, many years, and I ran a multi-asset fund, a $3 billion multi-asset fund. And in about 10, 15, I got the orange pill. And
Amazing. Well, I'm glad you didn't reveal all your secrets, because right now we have one of our favorite part of the show, which is the rapid fire questions. So Darius and I like to play a game of good cop, bad cop. I'll let you decide who's who. I think I know. We all know.
I think
I'm
I
the good
know
cop.
who's the good cop, but Max and I were often disagreeing.
Nevertheless, let's kick it off. So, how did you first get into gold, and when did picture enter the picture for you?
gold 1999. The price was about $255 compared to you just saying it in a high of 5,500. So that's a long way down from here. And it had come out of a 20-year bear market. I went to a presentation with a really, really old guy, a guy called Tocqueville who's Canadian. And he was saying, I've been following gold all my life. And, it's like, it's never been this cheap. And it's going to go up and up and up. And I believed him. And that was that. So I became very interested in gold, started to study it. And then in 2013, I got interested in Bitcoin. But in 2012, a hippie economist friend of mine had told me about Bitcoin. I said, don't be ridiculous. You cannot have money. You cannot have money on the internet. You can copy and paste it. And then
Maybe let me follow on 2013 with Bitcoin, Charlie. That's very early. Can you tell us, like, how did you get in touch with Bitcoin, like, back in 2013? Because this was, like, way before, like, even the first cycle, like, crypto cycle or bull market. Like,
I missed the good.
Were you buying stuff online, or how did you get into Bitcoin?
Well, I missed the good bit because the good bit was below $100, and I watched the $100 breakout, and before you couldn't open an account or anything. Everything happened so quickly. The infrastructure was terrible, but I managed to get small quantities. But I wasn't interested in putting large sums of money into Bitcoin. I was interested in understanding it. So what I was saying to people was take £20, $20, buy some, and then just move it around and halve it and quarter it, and then you know what I mean? Have a play with the wallets and that sort of thing. And so that for me was the excitement. And so I didn't really see it as a money-making opportunity in the initial step. It was more the curiosity. And I realized that it was when I realized that the blockchain meant that you could not cut and paste Bitcoin on on your screen. And when the penny dropped on that, then I became very interested. And of course, it's an alternative asset, and I've always liked alternative assets.
Makes a lot of sense with your background starting in gold as well. But have you since forayed into other digital asset investments other than Bitcoin, or really kept to the orange pill?
Yeah, mainly Bitcoin, but I experimented in the early days. And I made an effort to really move around as much as I could in the understanding, but it was never an investment per se. But then obviously I understand Ethereum, and we do crypto research here at ByteTree, and so I'm familiar with it. But we have an analyst, and he does the hard work and identifies the projects. I just write the macro bit. So, but yeah, I get it.
I think you're short selling yourself there, Charlie.
Yeah.
Great. What was your initial reaction to Bitcoin as someone coming more from a traditional background? I mean, you mentioned the fear that this could be copy pasted, etc., which was a problem from very early stage internet money attempts. So beyond that, what was your
Well, the volatility in those days was crazy. I mean, unbelievable, way higher than today. And so that was funny to watch. And then the infrastructure was terrible. So the exchange, no one really understood how money, like fiat money, communicated with Bitcoin, and the exchange process and custody. All of it was very, very strange. And there was certainly no professional custody at all. And so those sorts of things were, all would come over the next few years, and they were part of the evolution. But I guess what Bitcoin had at the beginning was lots of problems, and each one was solved. And today it has some problems, and each one will be solved. Any problem that's in front of it, it gets solved. I think that the most interesting one was when the bank said, we don't like this. So they stopped people from moving money to Bitcoin exchanges. The stable coin was invented, and Bitcoin grew even faster. Every problem has been overcome.
I think that's a story that speaks to Bitcoin's resilience as well. Despite early years of volatility, questions about infrastructure, multiple black swan events, difficult macro periods, the orange giant remains unscathed. And one other question, given that you do probably talk to quite a lot of traditional investors as well, what's one misconception that you think they still have about Bitcoin?
Well, I think people think it's still going to zero. A lot of people, institutional investors, they think it's I think no one says Ponzi scheme anymore, but just some crazy, it's not real, there's nothing physical, and they say it's going to zero. And I correct them. I say it's not going to zero. If it's bad, it's going to $1. So the risk to Bitcoin is everyone gets bored of it, and suddenly it stops becoming a thing, and something replaces it. It's not going to zero. It's going to become irrelevant in a bearish scenario. The system is not going to wipe out. So I think there's a big difference between a forecast of $0 and $1. $1 says, I believe the system will always work, which is where I am. But I think there's a non-zero chance that Bitcoin could be irrelevant one day. Yeah.
Okay. Yeah. Makes sense.
Which is, but obviously I think that's a very, very small chance. I think it's much more likely that it's going to remain relevant and grow from here.
Makes a lot of sense. And I think, Bitcoin has been cited as dead, thousands of times by multiple different media publications. So I think speaks to what you're hearing from traditional investors as well. And then my last question before I hand over to Darius is we'll talk about and we'll unpack the combination of having both Bitcoin and gold within a portfolio. But if you had to choose just one asset to hold for the next decade as a long-term investment, what would you choose? Gold or Bitcoin?
Well,
And
if you'd
why?
asked me a year ago, then I might have given you a different answer. But today I'm going to say Bitcoin. I think the starting point is so low. I believe that both of them will be relevant in 10 years, right? I have 100% confidence that in 10 years' time, they'll both be relevant and liquid assets. And I think Bitcoin's going to outperform gold over the next 10 years for two reasons. One, it's dirt cheap and oversold, and gold's red hot. I mean, I know it's come back a bit in the last month,
Yep.
but it's still a very, very high number. And I think that Bitcoin has a sort of natural demand growth rate, which is higher than gold's. So if you're starting, if your competition is that one's growing faster and starts from a low price and the other one's growing slower, starting from a high price, it's not a difficult question to answer.
All right. Well, that's why I'm the good cop, Charlie. I give you the
Okay.
questions that, are easier and maybe warm you up a little bit. But I'll now hand over to Darius for number
For the mean
6.
question. For public disclosure, the question I'm going to ask, Max actually wrote, so I don't know if you got any mean ones for me. But talking about Bitcoin and gold, Bitcoin is always or like often called the digital gold. Okay. Do you believe that Bitcoin is digital gold yet, or is it still earning that title?
I don't believe it. I understand why it's said because of the supply side dynamics, but I don't believe it's true, and I don't believe it will ever be true. I believe that Bitcoin and gold are fundamentally different. Lives on the internet, the other one lives in the physical world. I think the central banks may get involved in Bitcoin one day, but even if they do, that still doesn't necessarily change the correlation, because Bitcoin is fundamentally a growth asset sitting on a fast growing internet infrastructure. It likes risk on conditions, generally speaking. Whereas gold, generally speaking, prefers risk-off conditions. Hasn't always worked out that well recently, but that's the sort of story through time. And you can make that macro, and you can say, okay, when does Bitcoin versus gold, when's one outperform the other? Well, I'd summarize it very simply. If interest rates are going down, then gold beats Bitcoin. If interest rates are going up, which is growth, that means that Bitcoin's beating gold. Not perfect, but a pretty reliable indicator.
So if you don't like the digital gold narrative or like naming for Bitcoin, would you have another way to describe Bitcoin to, let's say, our grandma?
Yeah, the gold of the internet.
Okay, gold of, okay.
Yeah, and then physical gold, or some people call it physical Bitcoin, is the gold of the real world.
Yeah. Yeah. Okay. I never heard about the physical Bitcoin one for gold, but I like that. So we can also spin it the other way around. And the next question I have for you, Charlie, is when did you first realize that combining both assets, Bitcoin and gold, which are namely the most liquid alternative assets in the world, is superior to holding one or the other asset alone?
Yeah. Well, I would say that the penny dropped probably, um, I would say between 2015 and 2018. I think I got the idea early, but it didn't really, it didn't reverberate. It didn't really sink in for some time that actually there was a powerful use case from the low correlation. I saw the low correlation and went, yeah, great, low correlation.
Yep.
But then, so what? And then it was some time before I went, low correlation. That's really powerful. So in 2013, the gold price collapsed, coin went up 10 times or more. And then in 2014, gold was steady and Bitcoin collapsed. And then you kept in 2018, the gold started to rally, Bitcoin collapsed. And it just kept coming and going. Even in 2020, gold was running into the summer and Bitcoin was doing nothing. And then gold started falling and Bitcoin takes off. And it's like, how could you not see this? These guys work together. It's like a team in the relay race, where they pass the baton from one to the other.
It's like
And
a
I think that's
seesaw.
very interesting because I would argue that many investors, or like at least me in the crypto bubble, for us it's like either or. Either you're team gold or team Bitcoin, and then you have like all this analysis why Bitcoin is superior to gold because it's digital and it's transferable. And then you have like the other side, like argumenting why gold is superior to Bitcoin. But actually, like breaking like this type of mental model and actually combining the two was very innovative, or at least like it shows that you weren't thinking that way in a either or, let's say, maxi type of mindset when it comes to the two assets, Charlie.
Yeah, I mean, let me frame that in a couple of ways. The first is most of the world's population don't care about Bitcoin or gold. Yeah. So let's say 90% of people go, you're all crazy. Yeah. And then there's the gold people and they're old, and the Bitcoin people. This is at least 10 years ago. I think it's changed. But 10 years ago, it was the Bitcoin people were young, and there's some old people, and then the gold people were older. As a generalization. So being on Team Bold is a very small minority group with no friends in the world. So I was a very lonely person in this very, very small minority.
You have us, Charlie. Don't worry.
Well, I'm going to convert you from being Bitcoin Maxis into Club Bold, and we're going to grow from the middle. And I think that that's the first thing. But I think that the Bitcoiners were angry 10 years ago because they just wanted to grow and everyone was in their way, and they didn't like the establishment view who was anti-Bitcoin, and so the Bitcoiners saw gold as the establishment, not realizing the 90% were anti-gold as well. And the hilarious bit was that the Bitcoiners would use the same macro arguments: printing money, limited supply, you can't fake it, all this stuff, same arguments as the gold people, but they were fighting over which was the better asset. And I always thought it was a bit ridiculous, but yeah, eventually came up with the bold concept, which has some real breakthroughs, taking the best of both.
Charlie, would you say, and that's my second last question before we come to my favorite question that we always have in this section, is would you say Bitcoin might eventually become boring if its volatility keeps compressing? And is boring something bullish or bearish?
I think Bitcoin's volatility is well, it hasn't really come. It's been coming down for 8 years, but it's been pretty stable over the last 2. Will it come down further? Of course, with more liquidity and more adoption, it will come down. But let's look what happened to gold. I mean, gold's been consistently 15% volatility until the last year. Yeah, when it's now gone up above it, it's now about 22, 23. It's had a huge bull market. So the bull market has increased volatility. Yeah, in that case, there are commodities that can happen. I would say that in Bitcoin, the structural volatility, the cross cycle volatility is probably falling, but you're still going to have high volatility in bull and bear markets, and it comes in the consolidation periods. And the reason that Bitcoin's volatility would fall from here structurally is because it would go from a 50 billion asset a day to a 100 billion asset a day. More liquidity, more engagement with Wall Street and that kind of stuff. And so as that happens, price go up. Yeah. So you're going to have an appreciative period with the low volatility. There are no shortage of stocks that have done very well over the years with low volatility. I mean, look at the S&P 500. That's rarely volatile. And it's just been going up and up and up. Nvidia has been volatile. Tesla's been volatile, but Microsoft hasn't been. Google hasn't been.
Coming now to my favorite question of this segment, the one-word question. Charlie, one word to describe the current macro environment.
Uncertain.
Great. I think that's a great segue to our next section, which is unpacking a little bit of the backdrop in terms of macro. And why hard assets? Why now? So let's start with gold. Gold has rallied over 40% in the past year. And could you unpack a little bit about what's driving this? And if you think this is a sustainable rally?
Yeah, well, I think that it has probably gone further than it needed to. It's been a huge rally. And I mean, let's go back to, are we allowed to go back 50 years, 60 years?
As far back as you want, Charlie. I won't remember what it was like 50 years ago, but please do share.
Let me give you a summary of the world history of gold in 2 minutes. So you basically, gold is a formal part of the financial system until 1971. Yeah.
Mm-hmm.
And then it breaks, the system breaks, and we have the fiat system after that. A very important point for the fiat system is part of it's monetary and debts and things, but it's also technology. You think in 1971, this is the first time you can actually have a decent fiat FX system because communications, computing is good enough to handle it. Yeah.
Yep.
Otherwise, you've got pigeons trying to run the global FX system. It's not going to work. So the 70s were a breakthrough in computing and communications. It's where it really began. And so that's very, very important that fiat is a tech. Yeah, not just a terrible system of money. It's actually a good system of money if it's looked after, but the governments don't look after it. Switzerland's different. So you've got that. Gold is then free. We have an inflation era, oil shock in the 70s. Gold goes up a lot. People want security. Then in the 80s and 90s, we have the peace dividend, Berlin Wall, all of those things, and the inflation's coming down. And it's a very good time for financial assets. Very good time for bonds. Rates are coming down. Inflation's low. Gold is irrelevant in the 80s and 90s. No one needs gold because everything's going so well. Okay. Then we come after the dot-com bubble, 1990, 2002. Gold makes its bottom. 255, as I say. And people start buying it because it's so cheap. It's just too cheap. No one really knows why, but people decide to buy it. And then in 2008, we have a financial crisis and people really start buying it. And in 2009, the central banks in the East start buying, right? And central banks have been selling for 3 decades, and they now turn. You know, the Middle East countries, Asian countries, all of which have big reserves from exports. They start to invest those reserves into gold, and then so gold going up for a long time. And there's some problems and stuff with rates. It doesn't matter, big picture. But then after the war in Ukraine and the Russian reserves are confiscated, the central banks go, we want to have way more of our reserves in gold. So they go from like 5-10% gold weighting, and they got to 28%. And by the way, pre-1971, it was 70 or 80%. So, you know, there's the structural bid is from the central banks who say, the world is crazy. The currencies aren't what they used to be. This isn't the 80s, 90s anymore. The government paper is not very high quality. And so gold is a certainty and no one can confiscate it. Yeah. And they'd probably buy Bitcoin as well if it was more established.
I mean, that's something that we've also noted as of late with central banks continuing to buy gold, particularly the People's Bank of China. And I mean, if you look at gold's performance across the 3 main jurisdiction, like time zone windows, Asia and then Europe and EMEA, and then also the US, you see that actually gold's performance is actually, if not mostly driven by the Asian time zone, at least a portion of it is actually just solely in Asian trading hours, which just shows you about the kind of Eastern demand for gold there. So what does this tell you, in your opinion, about how nation states are viewing the monetary order of the world? Do you think there's a little bit of what I call currency weaponization coming from the US?
A little bit, but the US don't want the dollar up. They want the dollar down because if you think of a rich man who's, you know, low on cash but big on assets, the US government is kind of broke, but the US nation is very rich. And that's the way I like to think about it. And they can grease the wheels of the global economy by keeping their currency lower. If the dollar goes up, that just puts the brakes on the world economy. So, I mean, why would they want to do that? I mean, that's their export markets and everything. So,
Yeah.
it's attractive for them to maintain higher growth rates by having a soft dollar. And I think that's a policy choice. It's more or less been admitted. They never quite say we want a weak dollar, but they always say they want a strong dollar, but they act differently. But I think just more simply, I mean, countries like America, UK, France, Japan's a bit different, but it's a high-tech country. There's a lot of countries that it's just run out of room. If we had another financial crisis tomorrow, the government can't do anything.
So you think it could be coming more from that kind of risk angle of how indebted these countries are,
Yeah,
that people
totally.
are turning
Totally.
to neutral safe havens?
Yeah, because you look at government paper and you go, okay, fine. I mean, of course they'll pay you back, but pay you back with what? What's the
Yeah.
real element of that debt? And you just see it in the way bond markets are behaving. You know, they're not safe havens. We just had an invasion of, well, not an invasion, but an attack on Iran, and a big, probably more firepower than in recent wars in 2 or 3 weeks. We find bond yields don't go down; they go up. So U.S. Treasuries, historically, you'd say, okay, there's problems in the world, buy U.S. Treasuries. They
Yeah, I was going to ask you specifically about that. We're seeing gold completely outpace the demand for treasuries. Do you think that's temporary, or do you think that's more of a structural shift in hedging behavior worldwide?
Well, it's a sort of it's a response to the growing size of the debt. So gold, if you said at the peak your 5,500 number earlier, and I think at that number the gold market cap is 335 trillion.
Yep.
Yeah, what do we call that? 30 times Bitcoin, 25 times Bitcoin. And so that the asset is getting to a place where it's big enough to make a difference and be a counterbalance. On that argument, it probably needs to get to 100 trillion to really be an offset. But you go there in steps. You don't go there overnight, right?
Yeah, yeah. But then it does signal a little bit that this bid for gold, it's structural, right? The world is
Yeah.
seeking more politically neutral, non-sovereign store of values. So
And maybe, Max, just to add what you're saying, I think a word that we haven't brought up so far is the debasement trade, which I think is probably also a little bit of the answer of what we have been talking about. I don't know, Charlie, how do you see this narrative sprung up like the last 6 months? Are you a fan of it? Do you agree? Do you disagree? Is this the main reason?
It's a good narrative. I mean, the debasement trade has been going on since 1971.
Basically, since the dollar wasn't backed by gold anymore,
Yeah.
because this is what happened in 1971,
Yeah.
correct?
So it's an ongoing thing. I mean, the question is it happening slowly or quickly? Yeah.
and what's happening, obviously, in terms of the escalation in Middle East would point to the fact that this will likely speed up in the future.
I would think so because war is expensive.
Exactly. Yeah. I mean, every kind of interaction of the US in the Middle East has actually been followed up with the US printing more money to be able to finance that war. So I guess points to what you mentioned, Darius. So if gold, and you mentioned it has come off from the 5K, the time it breached 5K for the first time in history in late January, and you still see a potential for gold to grow from here from a long-term horizon. But where are we now in the cycle then for gold?
I would say that this cycle's tired. I mean, you have to go back to 96. So the return last year was like 70% or something. And you had to go back to 1978 for a better return. So that's a long time. It's too much for gold. And so what I was hoping would happen over 5 years happened in like 1 year. So, gold is supposed to grow with global nominal GDP, right? That's the model that the World Gold Council support. So if global nominal GDP is average 7 or 8%, so that's growth plus inflation around the world. And of course, places like India are growing quite quickly. So, not everyone's like Europe where they're growing slowly, but there are places in the world where they grow quickly. So so GDP growth plus inflation is about 7 or 8%, which is the same as saying, more or less the same as saying, the money supply grows at 7 or 8% per year. Yeah, because the money feeds
Yeah.
the world, right? So
No, exactly.
yeah, so that's how I'd see it. And then the golds have basically got ahead of the money supply, got ahead of that growth, and Bitcoin's gone behind it. So there you have it.
Maybe since we're talking and you just mentioned Bitcoin again, maybe moving a little bit from gold over to Bitcoin. Obviously, and Charlie, you mentioned this before at the beginning, like Bitcoin has a lot of the characteristics of gold, finite supply, incredibly neutral, and it's often labeled also as a store of value. Now, if you look at its behavior, at least like on a short time frame, like one could question this store of value characteristics for Bitcoin. What's your view on this? Is Bitcoin a store of value? And if yes, why did it not really behave like it, maybe on a short time frame?
That's just volatility. I mean, the store of value is something you measure over 5 or 10 year periods. It's not something you measure over a few weeks or months. So I think that's quite important. And people, social media makes everyone want instant gratification. So when Bitcoin goes over 100,000, 200,000, gets 200,000, 500,000, and all this, when's everyone happy? The price of Bitcoin is high today. I mean, 60, 70,000, 72,000. That's high. Yeah, that's for people who bought $1 or $100 or $1,000 or $10,000. It's good, and you can't expect it to go to $1 million. And then if it gets to $1 million, then what?
Yeah, we live in the attention economy, Charlie.
Yeah. So of course it goes up and down, but you draw a trend through that, and there's your store of value.
Yeah, makes sense. I mean, that's something that should be measured over a long time frame, right? Because
Yeah.
that is the point of a store of value asset, is to protect wealth over a long-term
It doesn't have-
horizon, not
It doesn't have to be
Wednesday till
long.
Thursday.
I mean, it could be a cycle.
Yeah.
Assuming there is a cycle in Bitcoin of 4 years, another question maybe, then 4 years would be a good time to measure.
Yeah. But maybe actually, I like that you brought it up, Charlie. Are you a believer of the cycle theory or not?
I 100% believe in a 4-year cycle, but it's nothing to do with Bitcoin.
It has to do with liquidity or global liquidity?
I think
or?
it's always been there. Here's my evidence, okay? I understand halving and all that. Here's my evidence. And I understand that Bitcoin goes into the cycle and the halving, and then I get it. But it's not possible because Bitcoin is correlated with tech, the technology sector, yeah? Which is 10 times, 50 times bigger, 20 times bigger, whatever. And it's pretty well correlated with the NASDAQ, but not so much the last 6 months. But software, social media, these kind of things, the correlation's always been high, as long as I can remember. Yeah. And it's impossible that Bitcoin drives the technology sector. Would you agree?
I would agree, but I'm going to play devil's advocate here.
So if Bitcoin is not driving the tech sector, and if you go before Bitcoin, there's evidence of 4-year cycles in the economy for 50 years, then, well, maybe that's the 4-year cycle. And the halving is slightly coincidental that it keeps, whenever the halving happened, people would blame it because it's 4 years. People would call it a 4-year cycle. And of course, Bitcoin is very sensitive to liquidity. And so in the old days, you would say, there's been a crisis. Who was in trouble? This time it was Asia. That time it was the UK. That time it was Vietnam. Whatever. You come up with some bond crisis or country crisis. And now it's always Bitcoin because it's an expression of liquidity. And the mainstream media like to report whenever it goes down. So you've got that. So yes, I understand the halving thing, but it doesn't make any sense that Bitcoin drives global markets.
Makes sense. I mean, on the topic of Bitcoin's correlation with tech, because it's something we also get asked about quite a lot. And do you think this is like a permanent characteristic of Bitcoin's, or is it just a reflection of Bitcoin's current positioning, or rather the perception of investors of Bitcoin as a part of the innovation complex? And do you think it one day would decouple from that?
It's possible that one day it decouples, but I think that, in the foreseeable future, Bitcoin is an internet stock. It was born on the internet. It lives on the internet. All its friends are on the internet. All its interactions are there. So how can you expect it to do different things to everything else on the internet?
Fair. I like to think Bitcoin now more of as a Jekyll and Hyde asset. And I don't know if you've read the book, but it's essentially an asset that still has kind of two faces. Sometimes it will perform well in risk-off moments, and it's not always as you pinpointed, but we did see, for instance, during the Russia-Ukraine situation in 2022, where it did have quite a favorable performance. And now on the flip side, during some macro tension, particularly through the start of the year, it has performed poorly. And so I just wonder is it enough that it is an internet asset that means it will always behave like the innovation complex? Because if you flip the logic and kind of say all non-internet assets, they don't necessarily all behave the same either.
That's correct. Yeah. So real estate and copper mining are completely different just because they're in the real world. No, I accept that. And it could be that the internet gets so big and so ingrained with the real world that you can't tell the difference. I mean, there's that. But I think
That's where I'm coming from. Yeah, that at one point our financial industry is
no,
digitized.
I can't disagree with that. But it's as things stand,
Agree.
it behaves like tech stocks because it is a tech stock.
Maybe looking at time, I want to talk more about, again, Bold. And you touched upon this in the beginning section, Charlie, but can you, again, for our audience, tell them what is exactly the Bold strategy and how was it derived?
So the Bold strategy is putting Bitcoin and gold together in an index called Bold. And Bold is obviously Bitcoin and gold. And the reason for it, why not just go and own Bitcoin and gold? Fine, go and do that. But there's some magic happens when you put them together. And there's two things that really matter. One is that the risk comes down, and the second is the returns go up. How? So if I put $50 into Bitcoin, $50 into gold, it's pretty obvious I've got more risk in Bitcoin than I have in gold. Yeah, because Bitcoin's more volatile. So we measure volatility, invert it using a simple bit of financial maths, and we put the same amount of risk into each asset. Now, historically, that's normally meant $25 into Bitcoin and 75 into gold. Yeah. That changes, but that's been the average for the last few years. And I'll come to the present in a sec where that's changed. But that sort of makes sense to most people because they perceive Bitcoin to be risky and gold to be stable. And so you try and maintain those weights. And in doing so, you have to rebalance regularly. And the Bold Index chooses to do that monthly. And when you rebalance, you have to bring the weights back, which means a transaction, even if it's just an index, a hypothetical transaction. So you're doing this magical strategy called buy low, sell high. Yeah.
I've heard that before.
You're selling the thing that went up that month. Yeah, so it was a good month for Bitcoin, you're selling some Bitcoin, and it was a bad month for gold, you're buying some gold to get back to your weight. So if you're doing that every month, yeah, and you believe they're both good long-term assets to own, then that process of rebalancing adds quite a lot of value. We say it's about 5% per year, but it's been more like 10. Yeah, it's huge, and it wouldn't.
So you're putting your capital to work more efficiently then, based on the idea that you have a positive long-term view on both of these assets, but you're just capturing that efficiency gain through frequent rebalancing.
Yeah, exactly that. And it wouldn't work if these assets had correlation. So if Bitcoin and Ethereum, if you did it with Bitcoin and Ethereum, you would not win anything. You just get the average outcome. Yeah. And if you did it with gold and silver, you'd get the average outcome because these things are highly correlated. You do it with Bitcoin and gold, where the correlation is really low, and they're completely different in every way, and they're different markets, and everything, then more often than not, you see a big day for gold is sometimes a down day for Bitcoin, and a big day for Bitcoin is sometimes a down day for gold. And it's not,
makes sense.
It's not perfect, but it's happening much more than you think, much more than in other assets. And so you're capturing this little bit of extra return. And because you've got the natural offset, you're doing the risk weight, you bring down the volatility. So if you think investing is a game of trying to get higher returns for less risk, Bold does exactly that.
Yeah, and I mean, on the point of Bitcoin and gold being inversely correlated, and obviously following that kind of monthly rebal frequency on a monthly basis, I mean, Bitcoin and gold over the last 3 years, they've exhibited a negative correlation. So points to that fact that they do work well in unison. And I always like to say, fortune favors the bold. And I just wonder if that saying is actually coming out because of the bold strategy. But nevertheless, you said that historically, Bitcoin had an approximate of 25% allocation within the bold strategy. And I think as of now, it's risen to around the highest levels ever in terms of allocation. What does that signal to you, or what's kind of the reason behind that?
Well, the first point, Max, is it's nothing to do with me. I designed the strategy, but I didn't sit here deciding how much Bitcoin and gold. That happens automatically through a measurement. And what's changed is that the volatility of gold, which is historically 15, 16%, in the last year, following the surge, has gone all the way to sort of 23, 24%. Which is a big move. And in the meantime, as we talked about earlier, Bitcoin's volatility hasn't been rising, it's been stable. And so the target weights come right down for gold and up for Bitcoin. So it's no longer 25, 75. It's now about 45, 55, which is a huge difference. And so as we came into March, I think what was most interesting was, how gold was showing this huge volatility. And then the price had a big fall, but the bold strategy actually had a higher Bitcoin weight than normal. And so, it fell less than it would have done if it had more gold, and it had more Bitcoin that actually went up. So, that's the strategy working its best. I mean, it didn't have to turn out like that, but it did. So I think that was really interesting. And I always said that Bitcoin and gold in the weights in gold would probably never hit 50% in my lifetime. But as I speak, the gold index is 48% Bitcoin. So
So
I
I
hope
do hope it happens.
it
Makes
Maybe
sense.
if we look into the future, forward-looking, Charlie, if you had to make prediction for both assets and then also for gold itself, like what's your future projection both for, let's say, gold and Bitcoin within the next 1 or 2 years?
I don't think a gold needs to go up at all in the next 2 years. I'm very bullish 10 years, but 2 years, I think it can calm. It's had its run. Unless something really bad happens in the world and the central banks really start lifting their bid. Will something bad happen in the next 2 years? Probably, quite likely. Will it be a good thing for gold? Not necessarily. The oil shock we've just seen hasn't necessarily been good for gold. In the oil shock of 1974, gold went down when oil went up. And then when oil came down, gold went up. So there was a low correlation between oil and gold in the 70s, as there is today. And so studying history of these things is important. And of course, most price terminals or chart systems don't go back more than 10 or 20 years. So people forget this stuff, even though the world hasn't changed in that sense. So yeah, I'm next 2 years, probably neutral gold. I'm very bullish for Bitcoin next 2 years because I think it's oversold and the new bull market begins soon, I hope. I mean, we haven't got much of a base yet. We've got nearly 2 months, and we're starting to see some inflows from institutions again. So all these things are quite interesting. And of course, the correlation with software and software stocks are now cheap on good old fashioned valuation metrics like cash flow, yield, stuff like that. And so when Bitcoin's correlated with tech and tech's cheap, that means Bitcoin's cheap.
Makes sense. Wow. I mean, I wish we could pick your brain a little longer, but maybe let's really just end and go through maybe some of the more kind of forward-looking questions that we have for you, Charlie. So we talked about the potential entrance or start of a new potential Bitcoin bull market. And what do you think that needs to happen, or what catalyst matters the most for Bitcoin's next leg forward in your view? Is it de-escalation of the geopolitical risk? Is it more regulatory push in the US through the Clarity Act? Is it cheaper, more abundant liquidity?
I think that Bitcoin's the most prejudiced asset that's ever lived. And the big institutions don't take it seriously. I mean, some do, but most of the big money doesn't. And I would say the global wealth management industry is $170 trillion. They're allocated 1 or 2% gold, and they're 0.0% Bitcoin. They really don't have any. And I mean, there'll be 1 or 2 institutions might have a little bit, or they might be interested or whatever, but no one in their mainstream asset allocation models has said, I'm going to embrace Bitcoin as a core asset. We haven't seen it anywhere. But it will happen. I think there's a very high chance that in 10 years' time, it will be completely normal for Bitcoin to be a core asset in investable portfolios. So we're going from here to there. And I don't think that movement has yet begun. Yeah.
Yep.
I talk to investors and they're more interested now. And as I said earlier, no one calls it a Ponzi scheme anymore. Yeah. So even a year ago, people, it's a Ponzi scheme. It's the most liquid, transparent Ponzi scheme that ever lived. Yeah. Whereas Ponzi schemes have zero volatility. I think Madoff had 7%, which he made it up as well. So low volatility is one sign of a Ponzi scheme. And if you could have a Ponzi scheme, you wouldn't have big bear markets. Yeah. And you wouldn't have huge transparent blockchains and liquidity. So of course it's not a Ponzi scheme. And I think people are no longer saying that as a criticism. They're just saying, well, it's not physical. Regulations are too difficult. Don't know what the boss will think, but guess what? The boss is old. He's going to retire. Someone younger is going to take his shoes. So sooner or later, we're guaranteed to see Bitcoin in portfolio. It's just a matter of time and it's coming. And I think that's why there's going to be a structural bid for a long period.
Yeah, well, I also share that vision with you. And, you mentioned you didn't think that gold would hit the 50-50 allocation between Bitcoin and gold in your lifetime. I sincerely hope that it does. But if you had to make a projection, when do you think that could happen? And what would that mean for the strategy? Does that change the approach of gold, or does that signal something deeper for Bitcoin as an asset class?
It could happen this afternoon.
Well, then I do hope it happens within your lifetime, Charlie.
Because Bitcoin's already about 48% because the price has gone up this month while gold's come down. And So it would only take a small, a 10% day in Bitcoin, and it's happened. Yeah. Well, obviously, we'd rebalance it again next month
Yeah, exactly.
to bring it back down to more like 42, 43, something like that. But to get the target weight, so the monthly
Yeah.
target weight, you need to see the same volatility. You need to stay bold and Bitcoin and gold to have the same volatility. As I said, it doesn't matter whether it's 50% or whether it's 10%, but if the same number
But
goes
once
into
they
the
reach
place,
that number,
50,
the
50 comes out.
magical, yeah, exactly. Makes sense.
It's not going to be wrong when it happens. It's going to be right because it's saying, well, actually, these things are equally
Are
crazy,
equal in risk.
equally crazy or equally calm, to put it how you want it.
Well, Charlie, I wish we could have you for a lot longer than we did. I might have to come over to the UK to pick your brain some more, but it's been a pleasure. I think the key takeaways are quite clear that, nations and corporations and just generally the world is kind of repricing how we think about safety, how we think about risk, and the demand for non-sovereign, neutral, safe haven assets is there.
Yeah.
Bitcoin's fundamental case does remain intact. And, we have the godfather of Bold here. As we've seen, Bold is a very disciplined approach to capture both sides of gold and Bitcoin, the largest, most liquid alternative assets in the world. And so for portfolio allocators, I think the question is starting to turn, as Charlie mentioned, that it's no longer if Bitcoin, but it's about when it will be Bitcoin. Anyways, any last words from you, Charlie, before we let you off the hook?
No, Max, Darius, thank you very much for your time, and it's been a pleasure to be on your podcast. And if you need some grey hair to give an opinion on a youthful asset, then feel free to give me a call all the time.
Thank you, Charlie, and also thank you for taking the time. Much appreciated. It was a very interesting and insightful conversation, especially for me being in my crypto bubble, always having this conversation between gold versus Bitcoin. Seeing approach like Bolt is very refreshing, and I also think the strategy is speaking for itself.
Yeah.
Well, thanks to the listeners, thanks to the viewers, whether you're watching on YouTube, whether you're listening while you're on your morning run on Spotify, make sure to leave a like, make sure to subscribe, and make sure to drop a comment with your thoughts. Again, please go ahead and check out ByteTree as well. Not only have they been the architects behind the Bold Index as well, but it is one of the most well-respected independent research houses as well when it comes to alternatives, gold, namely Bitcoin as well. So please go ahead and check out what they have to offer as well. And as always, we remain at your disposal for any questions or anything you guys may need. Many thanks, and see you at the next time.